Very good morning, friends. Welcome back to my channel, Smart Index Edge. Today, I am going to discuss one of the most powerful concepts used by professional traders, institutions, and market makers, but unfortunately ignored by most retail traders. That concept is called synthetic future. Nobody talks much about synthetic future, but you should know about this. Once you know about this, something enlightenment will come into your trading. If you are trading Nifty options, bank Nifty options, stock options, or even doing intraday option buying, understanding synthetic future can completely change the way you look at the market. Many traders only look at the spot price of Nifty. Some traders only look at the futures. Most option buyers look only at the option premiums, but smart money watches synthetic future because it reveals the real position of the option market. So let us understand this step by step. What is synthetic future? A synthetic future is a future position created using options. The formula is very simple. Synthetic future is equal to ATM call premium at the money call premium minus at the money put premium, whatever the amount you are getting will be added to the strike price. For example, suppose Nifty ATM strike is 25,000, 25,000 call option is 150, 25,000 put option is 100, the synthetic future 25,000 plus 150 minus 100 will give you 25,050. This means option traders are pricing Nifty at 25,050 even if spot Nifty is trading somewhere else. This becomes a very powerful clue. Why is synthetic future important? Many times, spot price tells one story, option chain tells another story, synthetic future reveals the hidden story. Think of it like an X ray machine. The market may look bullish outside, but synthetic future may reveal weakness inside. Or market may look weak outside, but synthetic future may reveal accumulation by smart money. That is very, very important. This is why professional traders continuously track synthetic future. Relationship between spot and synthetic future, these are the three situations. Situation number one, synthetic future above spot price. Suppose spot Nifty is 25,000, synthetic future is 25,080. What does it mean? Option market participants are willing to price Nifty higher than the current spot. The call options are becoming stronger, put options are becoming weaker. Institutions expect higher prices, this creates a bullish bias. As an option buyer, you should look for long opportunities. As an option seller, put writing becomes attractive. Situation 2, synthetic future below spot. That creates spot Nifty is 25,000, synthetic future is 24,930. This means option traders are pricing Nifty lower than the current spot. This is generally bearish. Put premiums become stronger, call premiums become weaker, institutions are expecting downside pressure. Option buyers may focus on PE opportunities, option sellers may prefer call rating. Situation number 3. Synthetic future equal to spot. That is neutral. That is what is happening. It is showing, the table is showing synthetic future as 23,966 and it is plotting as a neutral. Neither bulls nor bears have a major advantage. Range bound trading is likely. Option buyers should be careful because premiums may decay. Option sellers usually benefit in such conditions. How synthetic future helps option buyers? This is where most retail traders can improve dramatically. Many traders buy a call because price is moving up. Many traders buy a put because price is moving down, but they ignore what option traders are pricing. Suppose Nifty is falling, everyone becomes bearish. You are planning to buy a put, but suddenly synthetic future starts making higher lows, then higher highs. What is happening? Smart money is slowly accumulating bullish positions. The fall may be temporary. Short covering rally may be approaching. This information can prevent you from entering a bad put trade. Similarly, suppose Nifty is rising strongly, everyone becomes bullish, but synthetic future starts making lower highs. This indicates hidden weakness. The rally may be driven by short covering rather than genuine buying. The reversal may be approaching. This can save option buyers from buying expensive calls near the top. Synthetic future and short covering rally. This is one of my favorite uses. Suppose market opens weak. Retail starts, retail traders start buying puts. Fear increases, put premiums expand, but synthetic future refuses to break morning lows. Instead, it forms forming higher lows. This is often a clue that sellers are getting trapped. Once short covering begins, spot rises rapidly. Call premiums explode, put premiums collapse. This is why many powerful rallies start when most traders are still bearish. Synthetic future often gives the clue before price. Synthetic future and long unwinding. Now let us see the opposite. Suppose market is rising, everyone is buying calls, news channels become bullish, but synthetic future starts making lower highs. The gap between the spot and synthetic future starts narrowing. This suggests institutional confidence is reducing. Long positions may be unwinding, soon price may reverse. This warning can protect option buyers. So, role in option selling. Option sellers can use synthetic future. When synthetic future remains above spot and keeps rising, put writers gain confidence, bullish structure becomes stronger. When synthetic future remains below spot and keeps falling, call writers gain confidence. Bearish structure becomes stronger when synthetic future remains flat. Range trading becomes likely. So, friends, you need to be watching synthetic future. Expiry day is where synthetic future becomes extremely powerful. Why? Because option premiums react very quickly. Market makers constantly adjust position. A sudden rise in synthetic future often triggers short covering, gamma squeeze, call premium expansion, zero hero opportunities. Similarly, a sudden collapse in synthetic future can trigger long liquidation, put premium explosion, fast directional moves. Many expiry trade reversals are visible first in synthetic future. Combining synthetic future with Nalini Loren system, in my trading approach, I never use single indicator. I combine everything. Sometimes I use Loren system. Sometimes I use Nalini precision system. Sometimes I use ghost wall indicator. Everything I use. Even market memory, POC, everything for my confidence I will start using. So here in this example, I've used synthetic future along with the Nalini Loren system. Nalini Loren system gives you market structure. It is visible. That's why I use Nalini Loren system. Nalini Loren system gives you swing high and swing low internal range filters and also ORB. Here on the table you can see ORB bias. It is forming. It is telling. I am on the daily chart and it is showing synthetic future neutral with the put dominance it is showing. Because I have applied in the indicator itself, I coded for the put call and put premiums. I can feed in the strike price. So automatically it calculates and gives me the bias. So bias is multi-time frame bias. It is saying compression. Compression means it has happened compression. That's why it is telling the compression. So everything and signal it is telling weight and ORB range also it is giving. You can read the range has to be 209 and the synthetic value it is giving 23,966. Let me write down 23,966 and in this 23,966 the synthetic future bias it is telling neutral and where it is showing put dominance because while closing put became more costly. Then when there is put dominance, we can see opposite can happen. Market for a while it can gap up. Since it is showing a neutral thing, neutral thing, there may be range bound trade also. So if there is a range bound trade, only after opening you will come to know and after, how the synthetic future will develop. The way it has fallen down, and yesterday it was an inside bar within the bearish bar, probably they may continue to go sideways. So better to uh, I mean, watch on the market and the swing low it is saying 23,768 and the price is below the internal range filter, close below the internal range filter. So let me zoom it out. If I zoom the thing, you can see over here. So range is 209 points, the range of the yesterday's trade. So you need to be careful. You need to be careful. Suppose if it starts breaking below 23,794, it may trigger bearish sentiment, continuation of the bearish sentiment. Today we need to see usually the market makers push the market down to keep the market on Fridays itself. Friday is a very tricky day. You need to be very careful. Thank you very much for your friends. I hope I have made clarified the synthetic future, why synthetic future is very, very important. That's why I coded and added synthetic future into the Nalini Loren system. Nalini Loren system gives you put dominance, and I'm getting all the things on the table. I'm not going to manually calculate or anything. I'm feeding the input in the indicator section. So I'm getting, so I need not say it is a dynamic thing. While on intraday basis, it is a dynamic thing. I cannot go on calculating, but on intraday basis, it will be updating how it is going to. Let me go to the 15 minutes, 5 minutes time frame. Okay. And let me run the okay. It may not, the table may not update. Let us see whether it will update. So I'm running. Okay. It is showing, when I started here, synthetic, let me start from, okay, let me start from the beginning. From here I will start, okay? So it is bullish and synthetic future is telling 24,027 and the price was 24,024, okay? The call dominance it is saying. You can instantly, you can make out. Let me start playing this one. Just watch carefully. ORB range, it is updating 134. Synthetic future is 24,039. 51, the price is 51. 24,037. Synthetic future is going, price is above the synthetic future. So it is telling some sort of weakness over there. They are neutral actually. That's why when it is neutral, it is going sideways. You can see how it is updating. Even the table is updating on the playback mode. Just watch. At what time it became bearish? $24,085. Still call dominance it is showing. Call dominance. One p.m. now. Around 2 p.m. only market collapsed. After 2 p.m., 2:30 or something, market started collapsing and the put started gaining dominance actually. Let us see whether the table is updating that. See, so beautifully it updated synthetic future bearish. Then you could have looked for put option. Then you see on yourself the put option will see 24,000 put option or we'll see for the 24,200 put option. You can see it gained its this one momentum from around 2:30 p.m. from 208 it ran up to 289. High made was 309. So friends, this is how you can position yourself opposite. You will come to know as if it was bearish throughout the day. It dominated while closing. Thank you very much, friends. This is how you can make out with the help of my indicators. If you want to subscribe to my indicator, you just message me on this number 98452096000. This is a paid indicator. You will get all the details if you WhatsApp me on this number. Thank you very much. Nalini Swami signing off.